Welcome to the Passive Income Podcast. I'm your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Super excited for this episode. Joining me is yet another professional athlete, Raul. Please go ahead and give yourself an introduction.
Well, Dave, thank you so much for having me. I am a professional athlete. I play baseball professionally, and I also run my own wealth management firm. It's called Doc Shah Financial, and I'm super excited to be here. I think that my firm and the way that I go about investments is a lot different than what most people will talk about on X. I'm an active investor. I believe a concentrated portfolio is typically going to be better to build wealth over time. And I bust a lot of myths on X too. So I'm just happy to kind of be able to verbalize that now, in video to an audience.
Perfect. Yeah. Mythbuster. That's great. And I'm glad you said that too, that I highlighted the fact that you're another professional athlete coming on here on the Passive Income Podcast, but uh, you are also like well versed in the financial sector, the financial industry, and we will get into your website a little later on, and I'll pull that up, and obviously I'll have all the links in the description below and everything.
Sure.
Um, so I guess maybe I don't even know where to start here. Um, I guess let's just start with a little bit of your background and how you
Yeah.
became a baseball player. You're of Indian descent, where they play cricket. Born in I think you said London, England, where they
Yep.
play cricket, rugby, and not baseball.
Yeah.
and and now you're a baseball player. So I guess how did that happen?
Yeah. Well, yeah. I was born in London. We lived there for a couple years, and then we moved to the States. And I started playing when I was 6, and very classic story. But I fell in love with playing, and I played all throughout my entire life. I played at Johns Hopkins University. That's where I graduated from all 4 years. I was an econ and finance major there, and I started out. You know, I always wanted to get to the big leagues, and that was the goal since I was 6. And I've been very fortunate. I've been now playing for 7 years professionally. I was a member of Great Britain for the World Baseball Classic events. I played in a league called the Atlantic League, and baseball has been really great to me. I began managing my a couple of my parents' portfolios actually in 2018, and that was really the start of my investing career. And at the time, I was buying a lot of individual stocks in their accounts. And my dad was like, "Why don't you write articles on Seeking Alpha about the stocks you're buying?" So I thought, yeah, why not? I'm doing all the work anyway. So I started writing articles on there, and I started gaining a lot of traction. I mean, people really liked the articles, and I mean, this is a biased opinion, but I really think my articles were of a much higher quality than a lot of the other stuff on there. And really, for the fact that I think I know my stuff, but also I took a lot of time in between these articles. I mean, if you go and look at the average author, I mean, they're pumping out 1, 2 articles a day. If you copy and paste them in Microsoft Word, they're like a page, single space. So I'm
Right.
putting out really about probably 50, 60 pages per stock. I would break it up into multiple articles, but I would only write on stocks that I had, were buying for my parents' accounts. And like I said, I was gaining a lot of traction. The portfolios were growing very well, and I knew that, hey, I'm going to do this for other people and not just my parents. And so then last year, I went through all the regulation, compliance, everything getting started up. It's a lot when you're doing an investment firm. And yeah, so we got established, Doc Shah Financial, last summer, and we have 9 clients right now. We have 2 player clients actually from MLB organizations, and we have a little under 700,000 in assets under management, which is not bad for just being in business for 3 months. So
Yeah,
I'm very,
that's
very excited about this, and a lot of the same principles that I've learned applying for my parents' portfolios, and the success that we had is really just now for my clients.
yeah, no, that's impressive. 700 grand sounds like it's a big number, but it sounds like a small number when you're talking about some of these, investment firms. But if you've only been at it for 3 months, that's a great start, right?
Yeah, thanks. Yeah, I mean, it's all about perspective, right? And nothing goes up in a straight line. But you think about, yeah, good stock pun there. But when you think about most investment funds, I mean, the majority go bankrupt. So if you look at it from that perspective, it's not a pretty good start. You can't really compare and say, well, that firm has 100 million if they've been in they've been going at it for 20 years, right? So it's all about perspective. But really, the main thing is I love to evaluate stocks. That's my bread and butter. And I know as long as I can do that very well, I
Yeah.
think the assets will start flowing very well over time.
I am gonna quickly give a shout out here, a very special thank you to Millionaire Mentorship for sponsoring this episode of the Passive Income Podcast. Millionaire Mentorship with Abundantly Erico will teach you everything you need to know about options trading, from covered calls to cash secured puts and everything else involved in options trading. Millionaire Mentorship has you covered. Use the link in the description below to get started today. So, do you do any options trading, or is that any part of your strategy?
No, we don't do options trading. I mean, the accounts have margin and we put options on the accounts, but that's really just because for holistic purposes. But they're really never executed. In fact, every investor will get an investor policy statement, and in there, that's basically a constitution between
Right.
myself and the client that I write for every single client individually, and it'll show. Doc Shah Financial doesn't utilize margin, so that'll be very explicitly written there.
Okay, fair enough. Um, I know that you watched my recent interview with Eddie Lack, the former professional NHL goaltender, and you probably noticed that I ended up steering the conversation back to hockey and sports and playing the game. And he kept wanting to talk about real estate and real estate investing. So we might have that same little bit of back and forth struggle here. I
Tug of
want to
war,
talk
yeah.
about investing and that. And I'm going to just want to talk about baseball and sports. And I believe you did mention to me in one of your DMs that you had played here in Canada, in Ottawa, if I'm not mistaken.
Yeah, it was a brief period. Yeah, I played for a team called the Ottawa Champions, although they did rebrand. Now they're the Ottawa Titans. So I have visited Canada, and I thought Ottawa was beautiful. I mean, I really liked it. There's a lot of potholes, but I mean, other than that, it's a beautiful city.
Well, come in winter. That's when all the potholes get filled in by ice and snow.
Yeah, that's true. I'll have to keep that in mind.
No, nice. Yeah, no, Ottawa is a nice city. It's not really in my top 5 of favorite cities in Canada, but it is still a
Hmm.
nice city. I've been to so many cities in Canada, so
Yeah.
um, yeah, that's really interesting. And so you're still playing professional baseball, like at AAA or AA level, is that correct?
Yeah, I play for Major League Baseball has minor leagues and they have partner leagues. They're more or less really the same thing. Most recently, I played in the Atlantic League, and that's the league I'm hoping to get back in for 2024. It's a long season. It's just 100 and I think 40 games. It runs from April to October. And in baseball, for anyone that doesn't know, you play every night, and so
Yeah.
the lights come on at 7:05. And the stadium is full, but you report at like noon 1 p.m. and you practice all up until the game. You play the game and
And
then
then
you do the
extra
same thing
innings, and you're not out
every single
of the
day.
stadium till 1 AM, right?
Yeah, yeah. I mean, from the time you leave your house to the time that you get back, it's 12 hours usually.
Yeah.
Yeah.
Interesting. And so is that team affiliated with an MLB, like a major league team?
A lot of these partner league teams, they kind of go in and out of affiliation. So it just depends. But basically, what Major League Baseball would do is because your contract isn't owned by a specific organization, any of the 30 teams are free to sign you at that point.
I
So
see. So
it's
so
different.
it's not like this team is the AAA affiliate of the New York Yankees or the
Right,
Boston Red Sox or
right.
the Toronto Blue Jays or anybody. They just here's another league over here, and anybody's available.
Yeah, yeah. So they kind of look across the board. Okay, who's looks really good. If somebody from our farm system, maybe it's somebody not from our farm system, and usually it's merit based. And if you're playing well enough, you'll get an opportunity to get to the big leagues.
Nice. And sorry, I should have asked, and I'm not even sure. Is it pitcher or do you play a different position?
Second base, yeah,
Second base.
yeah,
I'm sorry, I saw one of your profile pics, and I'm just like, that guy looks like a pitcher.
yeah. No, yeah. I feel like somebody else has told me the same thing. Maybe it's the height because usually pitchers are quite tall.
Right.
Um, I think in your terms, I'm like 187 centimeters.
Yeah, no, we here
Yeah.
in Canada, we go by it. Canada
Do you
is
do
so
feet?
weird with back
Okay.
and forth with metric and
Yeah.
imperial. So it like height and weight, we go by like I'm 6 feet tall,
Okay.
170 pounds. B- But my
Okay.
driver's license, because it's government issued, it says I'm 183 centimeters and whatever kilograms, right?
Yeah.
Interesting. No, that's great. So even at that level, then you're getting paid money to play a game. You're obviously not making, the tens of millions of dollars contract for being the second baseman for the New York Yankees or LA Dodgers or Chicago Cubs or whoever. Um, but I guess even, at that in your age, and I know you talked, I know you heard me talk to Eddie Lack about this, about making those big contracts in your early 20s, or even the other athlete I had on here at Invested Athlete talking about, who was a CFL football player, talking about just getting paid money to play a game, right? Like,
Yeah.
I guess, what is that like?
It's great. I mean, you kind of forget that you're getting a paycheck. I mean, really, I can't speak for everybody else, but for me, right, you're always thinking, hey, I'm trying to get to the big leagues, and that's always the goal. And you really just focus on what you have to do that day in terms of training, and what drills and everything you have to do. Um, the money almost doesn't really cross your mind too much. I think when you look
Right.
back and you go, that's great, I'm getting paid for it. But really, it's always about just making sure that you're trying to get to the big leagues.
Yeah, yeah, yeah. I just for full disclosure, probably the only time I've ever made money playing any sport is if I maybe happen to win a golf bet,
Yeah.
and somebody's probably given me 3 strokes aside
Yeah.
to
Yeah.
win, right? Okay. No, that's great. That's amazing. Incredible story, I guess. Well, obviously, right? Like, born in England and coming over to the US, starting to play baseball, getting obviously really good at baseball. And that's another thing that so many people don't understand is, like, we see the pro athletes, whether it's baseball, hockey, football, whatever, on TV, basketball. But there's so many other great athletes that are, like, so close to making it. And some of them do, and unfortunately some of them don't. But it's just like,
Yeah, you can. Yeah, absolutely. I mean, there's always, there's sort of a small group at the top, and there's not really that much that differentiates them at the end of the day. And you can find that across the board, really, in any field, not just sports. I mean, you probably have some investment managers that are really good, and then you have
yeah.
majority that are not very good, and then whatever. Everyone kind of just slots into their own place.
Yeah, exactly. So, not to bore the viewers with my obsession of sports, let's get into financials. DocShawFinancial.com. I believe it is .com.
Yeah,
And
yeah.
I guess how that got started a little bit more. I know you touched on it there briefly, and even just how you started investing to begin with, right? Like, you're
Mhm.
this kid growing up in the US. You've got whatever, everything around you. And when did you first take an interest into money, and how am I gonna make my money make more money? Or that, like, that old cliche of, I need my money to make money while I sleep, right?
Yeah, it's actually on my website. Funny enough, it's on the homepage of my website. Yeah, it says
Yeah.
I want all my clients, to have their money working while they're sleeping. But yeah, to me, it's always very important, and I think to everybody, to have a balance, or the ability, the freedom to do what you want, and really nothing offers that like a stock can. It's really the most passive investment. It doesn't matter what you want to compare it to. It takes a lot of work to research the stock, and to find one that's mispriced. But once you find that and you put money into it, you really just have to keep up with the quarterly reports, and it's not really very time consuming. And it's my personal opinion that a diversified portfolio is a very lousy way to build your wealth. It's a great way to protect your wealth. You know, and an active portfolio is always going to be better, assuming that the portfolio manager picks great stocks. Now, if you go on X, most of the people will say, well, all these hedge fund guys, all these successes, there's so many studies, no one beats the market. And it's right, and it's not right. I mean, yes, most of, if you look at hedge funds, and a lot of these other alternative asset funds, yes, they don't usually beat the market, but you have to realize what they're intended for. Those are very short-term, risky trades that they usually make. I mean, no one opens a hedge fund to go buy, Walgreens, right? They're not buying value stocks, right?
Right.
When they open a hedge fund, right? They're trying to make very timely speculative trades that have such a huge payout that even if you look at it on a 5-year period, because that first year was so good, they would have still beaten the market. But any, for an investor to have returns that exceed the market, you really have to do a lot of research. And there are certain opportunities in stocks where they're so obviously mispriced that it doesn't make sense to not take advantage of it. And, because in this industry, there's so much regulation and compliance, I can't really talk about specific stocks because then people might think it's a recommendation. But luckily for everybody here, one of the stocks that I have written about on Seeking Alpha, I'll talk about because they're no longer a publicly traded company. So no one can buy it. So we're safe.
Okay,
And,
perfect.
if we
Not
go back to
financial advice is what we're saying.
right, and if you go back to 2020, right, when we had all the COVID stuff, there's a stock called Roots Chris Steakhouse. Okay, most people in America know it. They might have some in Canada too. I think they do. Roots Chris at this time, it's a very popular chain steakhouse. Roots Chris was trading at about $6 a share. I looked at the financials, the balance sheets, the credit revolver. They basically had about 2 years of liquidity. So, assuming the pandemic was going to be finished in 2 years, this stock was going to appreciate very, very quickly. And if you
Right.
sort of projected their cash flows out, it was at 6. I said it's probably worth about 2150. Now, there's no exact science, but people like an exact number. So when I
Yeah.
value it, you pick a range, but you kind of pick something in the middle. Anyway, you fast forward to a few years later, they went private at 2150, and that at the time, this is my personal account before I had an investment firm. That at the time was my biggest position. I had put about $60,000 in that stock, and went up from about 6 to I think I sold it at 18 or 19.
Yeah. So you
And
tripled your money basically.
yeah, so those opportunities are so far and few in between because you have to understand what the company does. I don't buy biotech stocks because I don't understand that industry. And you're never going to be able to make a good investment if you can't understand what that company does.
Right.
But I've been to Roots Chris Steakhouse. I've read the reviews. You can't find one that has anything less than 4.2 stars on Google. You know, the financials look good. They've been in business for decades. This was a no-brainer. And when you find opportunities like that, you got to go for them. You can't
Yeah.
miss those opportunities. And that is really the key to value investing. You have to be disciplined and you have to do your research. And if you do that, you'll make money a lot faster than if you just go out and you just buy, ETFs.
Yeah, I think that's a great point too about because I did well on a couple of restaurant stocks that I purchased in right around that time frame of 2020 when all of a sudden everything was getting shut down, and I'm looking at them going, these companies have been around for decades and they're going to still be around 2 to 3, 4 years, however long this pandemic goes on. Because
Right.
obviously in 2020 we had no idea what was happening, and so yeah, I made a couple purchases as well, and I did not triple my money on any of them, but I'm happy to say that I'm still like I'm up on all of them. So it was
Yeah.
kind of, and again, I don't want to use the term no brainer because there was some brains that went into it. It wasn't just throwing darts at a dartboard,
Hmm.
although I sometimes do that too, which again, not financial advice. Don't do that. um, But yeah, the restaurant stocks, if you took a really hard look at them and a deep dive in that time frame of right at the March 2020, there were some great buying opportunities there, right?
Yeah, absolutely. I mean, and that goes for really any market. But those opportunities, like I said, they don't come across very often in general. And they come across even fewer when you realize that you also have to understand what that company does.
Right.
And you have to be disciplined to a point where once you calculate what a business is worth and you buy that stock, ultimately when it reaches, in the realm of that valuation, you should let it go. And I always tell people that you should date stocks. You shouldn't marry them, right?
Right.
The stock doesn't know that you're in love with it. It doesn't care that you're in love with it. You
Yeah.
flirt with the stock, you date the stock, you have fun, and then ultimately when the time's up, you let the stock go and you break up. And discipline works on both ends of the spectrum. If it's not enough to just say, hey, I'm going to buy this stock when I know it's really cheap, you also have to be able to part with the stock when it becomes expensive. And most people would do the reverse, which is they buy overpriced stocks
Yeah.
and then they ultimately sell at a price when they should have been buying in the first place.
Yeah.
And really the first stock you buy is the most important just because of the law of numbers and how it works. If you buy a stock, let's say $100 stock and it falls to 50, right? Well, now you have to it's fallen by 50%, but you have to get 100% return to break even, right? You could take years to make up
Yeah.
for that one bad investment. So your first stock really has to be, you got to do the research in it and make sure that you're buying something for less than what it's actually worth.
A couple points there. So first, going back to the restaurant stocks and what you said about buying what you know, I think everybody understands how restaurants work compared to like your example of biotech.
Hmm.
I've been to many restaurants in my life, as I'm sure you have. I have been to exactly zero biotech firms or companies, right?
Right.
So I can totally agree with that point. I don't know how a biotech firm works, but I know how a restaurant works. I've worked in restaurants. Most people have worked in restaurants. You know how they work, you know the basics of it, right? Like it's
Yeah. Yeah.
more or less
Absolutely.
simple, right?
Y- Yeah, no, for sure. And there's a joke I always tell people, and if you look at doctors, right? If you look at the salary that doctors make, okay, doctors should really wind up all being decamillionaires by the time they retire, but many of them don't, and you wonder why, right? Because most of the publicly traded companies are biotech stocks. You ever look at a stock screener? They're all biotech stocks, and who on earth could understand a biotech stock? Right? It would be a doctor. I mean, they look at the literature, they understand all the terminology, right? They're part of the trials, that they're getting presentations by the pharma reps that nobody else gets. I mean, they understand the FDA they get everything, right? They have such an edge in this business, right? But they never buy the biotech stocks, right? Doctors are notoriously bad investors because they're all buying the oil drilling stocks. They have no clue about oil. They don't know how the oil is priced. They don't know what OPEC is. They have no clue. They go buy the oil tech stocks, right? But all these biotech stocks have really high valuations, and you sit there, scratch your head, go, well, who's buying the biotech stocks? It's the guys on the oil rigs buying the
Yeah.
biotech stocks. So people have this grass is greener mentality where they just don't buy what they have an edge in.
What
And
they know. Yeah, go with what you
yeah,
know, sort of thing, right?
yeah, absolutely. And again, that's another component of discipline is you have to be able to stick to what you know. And I think I tweeted this the other day, but I pass up thousands of stocks, or sorry, I pass up hundreds of stocks for every stock that I go, hey, that looks interesting.
Right.
And most people do the reverse. They're like, oh, I'll buy a little bit of that, a little bit of that, a little bit of this, and it's not a good strategy to make a lot of money. And that's what you
Yeah.
want in stocks. I understand the mindset of, hey, let's buy ETFs and we'll make 7% a year. And that is great for 99% of people, without question, 100%. But you're going to make money at a snail's pace. People, there's a time value to money. People want to enjoy money now. And if you have the ability and the opportunity and the inclination and the knowledge to buy a stock that you know is undervalued, that's something special that you maybe not, pass up.
You made another point there, kind of, and you were sort of alluding to people buying high, selling low. And I'm going to probably open up a whole can of worms here. I'm not sure if you want to get into it or not, but
Yeah, of course. Yeah.
Bitcoin is a perfect example of that. When Bitcoin was 65, $68,000, everybody wanted on board. When Bitcoin went to $20,000, nobody wanted to touch it with a 10-foot pole, right? And then if you had bought Bitcoin at its lowest rate, whatever the lowest was in the last year and a half, 2 years, at under 20,000, you'd be looking pretty brilliant right now, because I'm not even sure Bitcoin's up to what, around 45 or 50,000 again. So that's a prime example of, and again, this kind of a little bit goes back to the media, because 2 years ago, or 2.5, 3 years ago, when Bitcoin was at its all-time high of 68, almost 69,000, the media was crazy, right? Bitcoin was a media darling. And and then as soon as Bitcoin tanked, which Bitcoin does because it's very, very volatile compared to any other uh, investment class. And I don't know if you want to. I don't know if you're versed in cryptocurrency at all or not, but I'm sure you kind of know what I'm talking about. Like, Bitcoin is up and down all over the place, and that's a very specific example of that FOMO when it's at its all-time high, and then, like I said, when it's so low, nobody wants it, right?
Yeah, markets function off of human behavior and emotion. I mean, that hasn't changed for thousands of years. I mean, that is really the fundamental nature of every market. It's not rational, right? People have emotions. They see something going up, they want to buy it. They see something going down, they want to sell it, right? It's always panic and greed in that kind of a balancing act.
Yeah.
And that goes for any investment, any speculative investment, value investment, whatever you want to call it. It's true across the board. And anytime, the price of something goes up, see, people will conflate price with value. And so they think the price of something going up means that it's got more value, intrinsic value. And so they go and they rush and buy it. And I actually tweeted this the other day. So you can never buy anything, whether it's Bitcoin, whether it's a stock, whether it's a rental property, you can never buy something if you don't know what it's worth. Because ultimately, how do you know what the price you're paying for is fair, right? If I have a stock that I'm selling you, and this stock is $500, or we'll use your example. Let's say I have one particular cryptocurrency and it's $500, and the other cryptocurrency is $5, right? Well, which one is better? I mean, right? If you can't answer what it's worth, I mean, how could you possibly know which is going to give you a better return? And
Right.
so people, you'll see this, and I don't mean this in like a condescending way, but you'll see amateurs do this all the time, and you even see professionals do this all the time, where they look at price and they base their investment decisions off of price, and that's again another recipe for not very good things to happen.
Yeah, that is an absolutely great point. Like the current price, because whether it's cryptocurrency or stock market investing, whatever, the price fluctuates. It's up and down all day, every day, right? And what is the value though? The value, kind of going back to, I'm not sure if it was a Charlie Munger or Warren Buffett quote. Sort of, I'd rather get a. You might have to help me with the quote. I'd rather get a fair company at a good price than a
Yeah. I'd rather
yeah
get a fair company at a good price than a great company at a good price than a good company at a great price.
yeah
Yeah,
yeah.
yeah,
And that's kind of it exactly, right? You just want to get fair value, I think is what we're really talking about, right?
yeah. Ultimately, to really be able to sleep at night and to have done your due diligence and to know that what you're buying is an investment and not a speculation. You have to know what it's worth. And so in stocks, it's very simple. You project all the future cash flows and then you discount them, to account for the cost of capital. All right, so you can actually look at a business and you can put a price on it. You can say, hey, this business is probably worth $50 a share. Now, you and I, or you, or anybody else, we would never get the same answer, right? We're always going to have our own individual assumptions and expectations for any
And
business.
opinions.
An opinion, right? Exactly, yeah. And so we will get different answers. But if you the real trick to valuing is you have to pick conservative numbers. Because if you can pick very conservative future expectations and the stock still looks cheap, you've effectively baked in a margin of safety in your valuation. Because you've picked all
Right.
these very low numbers, they should be easy to meet. So normally, if they're going to exceed them, the stock's going to go up even higher. But again, yeah, you need to know what something is worth before you buy it.
Now I'm going to circle back to your analogy of dating a stock versus marrying a stock. And this is related directly to, I'm going to bring this into dividends, because
Hmm.
dividends are important, and I get the argument, a dividend paying company versus a growth stock. And we can get into all of that all you want. But is there any type of company that you would quote unquote marry and just hold forever because they are such a, like, say, strong dividend payer, or any reasoning for anything like that? Because I definitely have a few in my portfolio where it's like, well, hey, they're going to pay me a dividend until until the sun burns out, and I'm okay with that, right?
Yeah. I've never thought of, hey, I'm going to hold this company for its dividend. I mean, I did own a stock a couple years ago that I owned for the dividend, but it was an oil stock. They had a variable dividend. So I was making a lot of money on dividends. But then I ultimately sold the stock after a year. But, when you look at a dividend, dividends are great because they make people feel good, but they're really sort of a luxury tax for that. And the reason being is what in that example that I was giving you, right? When you look at all the future cash flows of every business, right? And you add it up, dividends get paid out of that future cash flow.
Yeah.
So when you remove the dividends, you have effectively lowered the valuation of the business. So like for example, let's say I was a CEO of a company and I could pay everyone, all the shareholders, a dividend, or I could just take that big sack of money and I could go in my backyard and I could light it on fire. Right? It would have the exact same impact on the company's valuation because that money no longer belongs to the business. It's gone. Right? So the valuation of the business, they're not retaining the same amount of cash as they would have otherwise. Now, if you're a little old lady and you want to live off your dividends, it makes sense to maybe hold some of these consumer staple stocks, that are probably never going to go out of business, or I don't want to say never, but very unlikely to go out of business.
Yeah.
And you're able to collect a consistent dividend check, and because you're maybe never going to sell the stock, even if the price goes down, you might not realize, a loss in capital. So, I mean, sure, there are certain circumstances where it makes sense, but, if you're really trying to build your wealth, you don't want to get in the way of that by trying to hold on to a dividend paying stock solely for the fact that it has a dividend.
Yeah, no, I understand that 110%. And you're right. If you are, approaching retirement or even in retirement and you just want that cash flow and you want that dividend, you're going to have basically, like you said, the companies that will probably not go out of business anytime soon. Definitely not in our lifetimes. The Coca-Colas, McDonald's, Costco's in the US and several here in Canada, the Canadian banks. And you just have the dividends for that cash flow and monthly income. But I definitely get what you're saying too, sort of the opposite side of the dividend stock. The CEO goes in his backyard and, like you said, lights that money on fire. It's no longer there. They could easily take that money and instead of paying a dividend to the shareholders, they could, there's so many other things they could do, invest it in R&D and buy back shares and pay down debt, and sort of the list goes on to
Yeah, I mean, I'll give an example. I mean, let's say that there's a company, and they pay everyone a dividend. Okay, the return on that dividend is zero because they don't have the money anymore. It can't be reinvested. Now, let's say the next year they say, hey, we're not going to give a dividend anymore. We're going to take that money. We're going to reinvest it in the business. Okay, and let's say that allows them to make 10%. So the business next year is 10% bigger. Right. Well, assuming that you bought the stock at a fair price, it grows by 10% the next year, you'll probably make a lot of money because the stock will have appreciated a lot. Now, maybe the stock will have appreciated much more than that original dividend payout. So you're better off in that case, right? So it's you never know. I mean, it's if you have a bad manager, maybe it makes sense for him to pay the dividend because otherwise he might reinvest it and actually lose money. Maybe the company shrinks the next year and the stock falls. So in that case, you actually hedged that poor management by actually collecting a dividend. So it's never a black and white thing. I mean, a lot of it is really just preference and everyone's own individual risk tolerance and age and what kind of makes them feel good at the end of the day and if it meets their goals.
One company that I think is the best of both worlds on this, and I don't own the company and I'm not a user of the company, and they have a very, very low yield, but Apple is one of those companies where you just look at them going, wow, they have such an amazing consumer base. They are growing every year. They pay a very, very small dividend. The yield is something like 1 or 1.5%, maybe close to 2%. I'm not even sure. But that's the type of company you look at going, well, they're probably still going to be growing for the next 10, 15, 20 beyond years, right? So, any thoughts?
Yeah,
Go ahead.
there's all kinds of. I mean, a lot of great companies, pay dividends, and they might be around for a long time. And if you are someone older and you like collecting the dividend checks, and it suffices for your lifestyle. I mean, one of the things that you don't see on social media a lot because it's so polarizing. But every investment decision is personal, and every something that maybe doesn't even make the most financial sense makes sense for that person. I tell clients this all the time, like. We do have actively managed portfolios, and all my clients are, they're risk tolerant, and so they're okay with that. But let's say I had a client that couldn't sleep at night if their portfolio was going up and down a lot. Well, maybe then we reduce the volatility of that portfolio, even if it means we buy investments that probably won't generate the highest returns. Because what's your health worth? I mean, if you can't sleep at night, then who cares what the stock is going to pay you?
Right.
So not every investment decision is a purely financial one, and personal characteristics are important too.
We've we've said that so many times here on the Passive Income Podcast, so many times I can't even count. Personal finance is personal.
Yeah, and it's funny because I keep using X a lot because obviously we're both active on there, and yeah, I mean, how many times have you seen some variation of this? If you want to be rich, buy a Corolla. If you want to be rich, don't spend more than $10,000 on your wedding. And there's this like shameless bashing of don't spend, don't spend, don't spend. And you're never going to become.
You have to drive a 2006 Toyota Corolla. You can
Right.
never go to Starbucks, and if if you get married, it better be at City Hall.
Right,
Right?
right, yeah. It's just these ridiculous things, and it's like, if I'm president, the first thing I would do is I'd pass a law that if you post any tweet that resembles that, you have to also put all your bank transactions like in the following tweet, so everybody can see what you're doing. But you know, it's you can't save your way to being a millionaire. I mean, you could in theory, but first of all, there's a floor to how much you can save, right? There's a very hard limit on once you get to a point. I mean, what are you gonna do? Not eat? You're gonna live in a tent. I mean, there are certain expenses you just cannot eradicate. So
Yeah.
the only way that you're really gonna make a lot of money is if you invest it and you grow your income or you grow your investments. But you're not gonna get there by saving it. And that's not to say just go out and spend money on anything you feel like, but obviously, like, you have to live your life. And really, is with my clients, we don't go over budgets. And the people who have CFPs, on X are going to go crazy because that's like one of their first things. Like, oh, we have to go through a budget. And look, budgets are like diets. Okay, nobody likes them. Okay, nobody sticks with them. And even if you do, how long is that going to last? You're really going to sit there and put every single thing that you buy down? I mean, what kind of a quality of life is that? I wouldn't do that, So
Yeah.
you have to get people to a point where they understand that, hey, we need to obviously not go crazy with spending, but let's focus on where we can get the most bang for our buck, and that's making good quality investments and long-term investments, not speculative investments, and then letting them do their thing.
I actually have been doing that for about the last 4, maybe 5 months of, on one of my sheets in my current I call it my income and expenses, spreadsheet, where I have been tracking every single expense, and it's more just for myself for an eye-opening,
Mm-hmm.
uh, an eye-opening exercise of where is my money going, right? And it is eye-opening, but you're
Yeah.
right. I'm not going to do this forever. I'm going to do it for 6 or 8, maybe a full year, 6 or 8 months,
Mm-hmm.
maybe a full year, just to kind of like have that eye-opening, that maybe that light bulb moment of, hey, you don't need to be spending that much at store A, store B, or store C,
Yeah.
or whatever, right?
Yeah, no, I totally agree, and I think even going a year is probably longer than the vast majority of people would go.
Yeah,
And nowadays when people talk about diets, right, they always say, "Well, don't do a diet, make a lifestyle change because you want this to be for the long term." And I try to apply the same concepts in investing in personal finance, which is you want the things that you change to be for the long run, and if
yeah,
you're not going to stick with it, it's probably not worth doing for an extended period of time outside of, like you said, hey, let's at least figure out where the money's going, and then make the change.
yeah,
But kind of relying on that to be like your sole guide, I don't think will yield the best results. That's my personal opinion. People might disagree, but I don't think so. And really, with budgeting too, like when I have a client come to me, ultimately I have to get their bank statement. It's part of the process because we link the brokerage to the bank statement. And inevitably, everybody says the exact same thing. They go, please don't look at my transactions. Everybody says that. And I go, look, I don't care about the transaction. I just need the routing number. I just need to put the statement uploaded, to Charles Schwab. But the other thing with that is budgeting is an uncomfortable conversation to have with people. And it's
yeah,
one of the reasons people don't want to seek a financial advisor because they feel like they're going to be reprimanded for it.
yeah,
And,
yeah,
and, and so, you need to find a way as an investment advisor or financial advisor or whatever to help the client understand that, hey, it's okay to like what you like. No one's perfect. It's okay to, you like shoes, whatever. Okay, how do we fit that into your plan? Not, oh God, stop buying shoes. That's not my
mhm,
job. I'm not the shoe police. I'm here to help you make your goals. And the way, in my opinion, like I said, the best way to do that, focus on your income, focus on investments, make that really, really good. And usually the rest kind of takes care of itself outside of extreme circumstances.
right, right. So, I never spend money at Starbucks, and I am in a very lucky position here in Canada with Tim Hortons that I
Mm,
almost always have Tim Hortons gift cards that have been gifted to me, so I
yeah,
spend very little on Tim Hortons as well.
yeah,
I do go there a lot, but basically they're just nice gifts. People give me the Tim Hortons gift cards, and I use them.
yeah, yeah.
Okay, I am going to pull up your website. Give
All
me
right,
2
here we
seconds
go.
here to get the share screen going, and it is docshawfinancial.com,
You got it.
and there we go. You should be seeing that on the screen
Oh,
now.
there it is.
Nice, nice. So we'll just quickly go through this. I
Sure.
honestly, I have had a couple comments saying you don't need to spend so long on people's websites. We put the link in the description. We can read the website ourselves. But I do
Hmm.
want to point out that you have a great website here: financial planning
Oh,
and
well,
investment
thank you.
management for athletes, professionals, families. You can talk to Raul here and all sorts of things. This is exactly what you talked about there
Yeah,
a little
yeah.
while ago. I want all my clients to sleep well at night, knowing their money is quietly working for them in the background 24/7, 365.
Oh, who's that good-looking guy? Who is he?
That's you, man. That's you.
Here we go.
So yeah, again, this link will be in the description below. Anything you want to say about your website here? Obviously, there's other the about, the services, the fees, FAQ, contact.
Yeah,
Um,
no, it's everything is up there, and I put my fees right up on the header as a separate tab. A lot of people don't do that. I believe in full transparency, so I put it right there for everybody to see.
yeah, right there. There's a phone number. Make sure his phone goes crazy tomorrow, and you can email Raul at docshawfinancial.com as well.
Anytime.
Awesome.
Yeah, no, I
Yeah.
appreciate you showing it. Yeah, thank you so much.
Are you crazy though, putting your phone number there?
I have two. I have a personal and I have a business line. So it's actually two separate phones. And part of that's also for regulation purposes because there's a lot of strict rules about record keeping. And so honestly, it's just much easier to have a completely separate phone so that, because when you upgrade your personal phone, you might lose stuff and then that could be a problem or that would be
Right.
a problem. So yeah, just keep everything separate.
Okay, well, the phone number is right there on the website. That website will be linked in the description below. Be sure to blow up his phone tomorrow with texts and phone calls.
Go ahead. I'm ready.
Awesome. Awesome. I'm going to bring up your Twitter profile in a minute as well so people
Okay.
are able to find you on Twitter or X. I don't know. Are we calling it X? Are we calling
I
it
guess,
Twitter?
yeah. I would write Fin Twit before, and now I've been starting to write Fin X. I don't know if that is, the same anymore, but I'm trying to adapt.
I mean, honestly, we've been having this same conversation here on the Passive Income podcast now for how long ago did they change it? Like 6 or 8 months ago. We've been having the same conversation. Nobody knows. Do we call it X? Do we call it Twitter?
Yeah.
If you look up here at it's still called twitter.com. So
I'm right. Yeah.
uh this link will also be in the description. You can find Raul at Raul_DSF.
There it
And
is.
then the
Yeah.
Doc Shah Financial, that's a great header, the investment management and financial planning. Then you got a baseball pick there as well, and then
Oh,
your
well,
profile pic here that makes
thanks.
you look like a pitcher, not a second baseman.
Yeah. Yeah. No, I appreciate that. Yeah. I thought it's good to maybe show a little personality, kind of stand out. I like the background and everything in the stadium. So,
Nice. That's awesome. I feel like we could just keep talking forever, and I'm open to keep talking, and I
yeah.
really do wanna kinda just sort of touch on anything more that maybe I haven't brought up that you'd like to mention.
Yeah. I mean, that's a good question. I really think that there's some great information on X, and I really think that there's a lot of poor information on X. And one of the things that we talked about, was diversification. But there's even a lot of more minute things, like people think volatility is risk. It's not risk. Volatility is really opportunity. People
Yeah.
think dollar cost averaging isn't market timing. I see probably at least every other day somebody tweets, I don't time the market, I dollar cost average. And dollar cost averaging is actually the definition of market timing. And I post about a lot of these things. Those are a couple off the top of my head, but even things like inflation, people think inflation is when prices rise. That's not inflation. Inflation causes prices to rise. Inflation is just an expansion in the supply of money. In fact, it doesn't even make sense in the context of a price because a price can't rise or fall. I mean, sorry, a price can't inflate or deflate. It can only rise and fall. So I mean, there's just a lot of things on X that I try to really clear up And because I'm still in the growing stages, it's not getting circulated that much. But I really think, as I continue to grow, I think a lot of these things will get cleared up.
Yeah, for sure. Explain that one to me because I'm kind of huge into dollar cost averaging, meaning, I get paid every 2 weeks.
Yeah.
I get dividends every month or every quarter. I use all of that, not all of my paycheck. Obviously, you have to pay bills and eat food,
Hmm.
but every 2 weeks, I put however many X dollar amount into my brokerage. I reinvest my dividends. So basically, I get paid every second Thursday. So whether it's Thursday or Friday morning, I'm buying more shares of company A, B, or C. And that is dollar cost averaging, correct?
That's lump sum investing, because your dollar cost averaging is when you have a pool of money and you purposely withhold some of it to invest at a later date. So just because you're getting paid every 2 weeks doesn't mean that you're dollar cost averaging. Because let's say you get your paycheck, okay, and after all your expenses, there's $1,000 left over, and out of this $1,000, if
How
you
much
take
do you
that,
think I get paid? There's not $1,000 left over.
well, I'm trying to pick round numbers. I always pick really easy numbers to work with because it makes the percentages stuff easier.
Yeah, fair enough, fair enough.
So, okay, so you have $1,000 left, after all your expenses. When you take that and you put it into the market, that's a lump sum. It's the entire amount. It's all your investable assets you've put into the market.
Even though it's
Dollar
every
cost,
2 weeks, I'm not dollar cost averaging every 2 weeks. I'm lump summing every two
you're
weeks.
lump summing because you're investing everything that you could possibly invest, that you're capable of investing. You would be dollar cost averaging if after all your expenses you had $1,000 and you decided, hey, I'm going to put 800 in stocks and I'm going to keep 200 to just see where the market goes. That would be dollar cost averaging. But when you do it every 2 weeks, but it's your entire paycheck, it's a lump sum. And people get confused because if you zoom out enough of a timeline, I mean, everything would then be dollar cost averaging. I mean, if I have 50,000 in principal and I put that today, and then I make $10,000 in 6 months, and then I invest that. I mean, you could say that that's dollar cost averaging, but it's not. It's a lump sum. People get confused because they think lump sum has to be a big amount. It's not a big amount. It's just the whole
It's
amount.
just the
It's
sum of
it's the it's
whatever.
it's the per, it's the percentage of whatever amount you're going to invest. If that percentage is always 100%, it is a lump sum investment.
That is interesting. I've never thought of it that way or had anyone else explain it to me that way because I've just always thought, hey, the market goes up and down, whether it's every day, every week, every 2 weeks, every month, and so I'm dollar cost averaging, thinking that every 2 weeks when sometimes I'm getting that at company A at $50, sometimes it's at 55, sometimes it's at 60, and so I'm just averaging between 50, 55, and 60, over the course of a year or however long, right?
Yeah, and again, people will get confused because they think of it like they're not thinking of the percentage of how much they're investing. They're just thinking, oh, okay, it's a small number and I'm getting it regularly, so I must be dollar cost averaging. And like I said, if you zoom out enough, everything is dollar cost averaging, right? But as long as you're investing everything that you have in that moment and you're not purposely deferring some of it, to the future, then you are lump sum investing.
Wow.
And dollar cost averaging is market timing, because let's say that you had, same example, you have $1,000, okay? You decide, you know what, I'm only going to put 800 in, and I'm going to keep 200, right? Well, why would you do that? Right? The only logical reason you would do that is because you think there is a chance a month from now, a year from whatever, whenever you're going to invest it, that the price could be lower. That's the
Yeah.
only reason. Because if if you knew the price was going to be higher in 2 weeks, you would just invest everything today because that'd be the best price you could get. But if you think there's a chance, well, then you're going to withhold some and invest it later. That's why it's market timing, because you are purposely deferring money that you could invest today to some arbitrary point in the future on the chance that it could be lower.
Yeah. So a more true definition of dollar cost averaging is, let's use your example of $1,000 and you get paid every 2 weeks. And instead of investing all $1,000 on that, Friday payday, you just invest $100 every day for those 10 business days until your next paycheck. That's a more true example of dollar cost averaging.
Yeah,
Would you
that would
agree
be
with
true.
that?
Yeah. Yeah, exactly. Yeah, basically you look at how much, not necessarily what you make, but what are the amount you're going to invest? You've paid off all your expenses. You have now this pool of $1,000 left, right? That's the lump sum. If you don't invest 100% of that, then it becomes dollar cost averaging.
This is like mind blowing for me. Like it really is, because I've just always thought, hey, I dollar cost average every 2 weeks. I just, whether the market's up or down, I put this amount of money
Yeah.
into these stocks.
And think of it this way, Vanguard has done a study on this too, by the way, but lump sum investing always will yield better results than dollar cost averaging. And the question is why, right? And the answer is because time in the market has a greater effect than timing the market. So when you lump sum, right? Let's just take a buy every 2 weeks, right? So it's Monday, right? The first of the month, whatever. You get your paycheck, you got this $1,000, and you put it in all on that Monday. Okay. Now 2 weeks later, you get your next 1,000. Okay, and you put that 1,000 in. Right. So that first $1,000, you invested it for the maximum amount of time that you could have, right? Because the second you got it, you put it to work. And then that next paycheck came, you got 1,000, you put it in immediately, and that paycheck, that $1,000 is now working for 2 weeks until your next paycheck, right? So you have maximized the time that you have spent in the market. If you dollar cost average, what have you done? If you take that $100 and you split it up, okay, you do 100 today, 100 tomorrow, 100 the next day. 100, well, each subsequent $100 is getting less exposure in time to the market because you keep delaying it more and more. So you are deferring all of these investments. You're spending less time in the market, so you're not going to make as much money.
Wow. Okay. Yeah, no, I understand. It's honestly, you're the very first person out of, I think we're up to episode 132, 133. You were the very first person to explain the difference between dollar cost averaging and lump sum investing like that, in that aspect. And what you're saying makes 100% sense. I get it.
Yeah, yeah. And, both strategies, by the way, are great. There's nothing wrong with it. As long as you invest, it's great. But
Yeah.
it's just that is one very common misconception I see on X all the time.
Right.
Yeah. Yeah. And I mean, we could keep going. I mean, you could take one look. In fact, I have a thread in which I literally put all the myths that, I think aren't true. Let me see if I can find that.
Yeah, please do. Please do. Well, you're looking for that. I'm going to give a quick shout out to Patrick at buyinvestingshirts.com. And as you know, there's so much great merchandise over there. You can receive a free passive income posse, turn that cash register around coffee mug with any purchase over 100 Canadian dollars before taxes and shipping at buyinvestingshirts.com. Use code word posse for 5% discount on your purchase. Link in the description. Did you find the thread you were looking for?
I did, yeah. We actually covered a few of them. We covered, dividends not being free money, sort of a luxury tax. We, the two we haven't really covered are volatility, is risk, and then inflation isn't a rise in prices. You want to pick one of those and tackle, or?
Yeah, well, we kind of touched on volatility a little bit with sort of the Bitcoin example,
Mhm.
and you did kind of touch
Yeah,
on
that's true.
the inflation as well. But let's dive into the inflation versus rising prices. I'm really curious to hear your take on this.
Yeah, so inflation is when you expand the supply of money. Now you can do that in different ways. I mean, obviously, if you have stimulus checks, you've expanded the supply of money. When the Federal Reserve, lowers interest rates and they're injecting liquidity into the markets, right? That's expansionary. And then also, if bank reserves get lowered, or the lines of credit open up and more people are borrowing money, right? All of these are expansionary. And when you expand the supply of money, that
So just
causes.
I'm gonna so the expansion of the supply of money is exactly what happened there, say 2 years ago in the US. They printed trillions of more dollars. They did the same thing here in Canada, not trillions, but they printed way more money. I believe every G7 first world nation, Germany, Japan, Australia, everybody printed more money. So the supply of money skyrocketed.
Yeah, right. So exactly. So and a lot of the, most of the major, anytime you have a central a bank that is sovereign country and you're printing your own currency, this inevitably happens. But yes, everything you said was correct. And when you expand the supply of money, that is inflation, right? Inflate is an expansion, and prices, like I was saying,
He wants to make sure everyone's still awake.
That one scared me. Anyway, like I was saying, we'll get back on track. Prices rise and fall, right? They don't inflate and deflate. The only way you're going to inflate a price is if you write it on a balloon and blow air into it. So
Right.
when you print a lot of money, you haven't done anything to the supply of goods, right? And people don't realize this, but when you and I go to the store to buy milk, okay, we're competing for that milk, right? We're bidding for that milk. If all of a sudden we have more dollar bills in our pocket and there's the same amount of milk, well, now we have to outbid each other. So the price is going to go up and it's going to filter out the people who aren't willing to pay what the market wants.
Right.
And so when you inflate the supply of money, prices ultimately go up. But inflation is not the rise in prices itself. And the reason people define
The
it
rise in prices is the not the cause, but the result, right?
exactly, yeah, it's the result of inflation. And the reason, people like to define it, like they like to say that if prices go up, that's inflation, is because it sort of shifts the blame, right? Because if you have a government, and I'm not, this isn't a political thing, I'm just saying sort of in an economic sense, okay, if you have a government that prints a lot of money and prices go up, well, the people would be mad at the government because they say, look, you're printing all this money, right? The prices are going up, right? We can't afford anything. But if you redefine the word inflation, and it now means that it's just that the price going up, well, then now who's at fault, right? It's the business owner because they're the ones technically raising the price. So you kind of shift the blame. So there's an incentive to do that. But once you really understand what it is, then you can actually start to protect against it. Because if you can't even understand the definition of inflation, well, then you're not going to be able to make adjustments to your portfolio that are going to actually be able to counterbalance that.
Yeah, and interesting points because people have always thought, myself included, okay, they print more money, and that means there's more money available. So, at the start of the supply chain, because that's where it starts, whether it's milk, eggs, uh, black beans, whatever it happens to be, right? That price all of a sudden does start to rise. And but what you're explaining is that's more of the result, not the cause. And then that just kind of gets trickled down. There's okay, the farmer grows crop A, it gets put onto a truck. That truck goes to a facility to have be cleaned, processed, packaged, whatever. Then it goes to another point to a distribution center. That distribution center eventually gets it to your Walmarts, your Costco's, your Sam's Clubs, and all the other grocery stores that we have here in Canada. And everywhere along the way, from point A, B, C through, all through this supply chain, you're adding a few pennies, a few pennies, a few pennies, and then you get to the end consumer in the grocery store looking at the price on the shelf going, what just happened kind of thing, right?
Yeah, the milk that you're buying, if we're sticking with this example, is not any more special today than it was a year ago, right? The volume hasn't expanded, the nutritional value
No, it's
hasn't
the same
expanded, right?
farmers milking the same cows, putting it on the
Right.
same
So
trucks, going to the
everything is
same
identical.
dairies, right?
Everything's identical. The only difference is that people are bidding for that milk with more dollars. And because there's a limited supply, it's going to get rationed to the people who are willing to spend the most. So, but
Right.
if everybody now has more money, then naturally the bid price goes up because
Yeah.
it's a limited supply. If there's unlimited supply, it wouldn't matter. You could print as much money as you wanted.
Yeah. No, that's a great point. It like the supply and demand because person A says, "Hey, a year ago this milk was $3 and I don't want to pay more than $3." And then person B says, "Well, a year ago it was $3, but I still need milk, so I'll pay $4."
Yeah, exactly. Yeah. And so you basically kind of filter out the people who can't afford it or who aren't willing to buy it. And it ultimately goes to the people who demand it, right? Who want it the most. And because
Right.
demand is measured in dollars, right? You're bidding for these things. The more dollars you bid, the more you're signaling to the market that you're demanding it, and the price ultimately would go up because the supply has been fixed.
Wow. Awesome. I see we are already pushing an hour, and I really do feel like we could keep talking forever. I definitely want to have you back on one of the live stream roundtable panel discussions with other people. I do want to give another shout out to Abundantly Erica and Millionaire Mentorship for sponsoring this episode of the Passive Income Podcast. Raul, before we sign off, anything you would like to say in closing?
No, I would just like to say thank you so much for having me. I've been really looking forward to this all week, and I had a wonderful conversation with you. So I'm very grateful to have been on the show, and I hope it circulates. I hope it gets a lot of views, and people will learn a thing or two.
Yeah, I hope so too. Like I said, it's been an absolute incredible conversation with you. Very eye opening. Some of the ways you've made me suddenly think about things as well, which I appreciate that. I truly appreciate that. So I do see we're already over an hour. If you're still here this long into the episode, please be sure to hit like and subscribe.